Hey everyone, so this is module 2. We're going to be looking at breakouts versus ranges. In module 1, we learned how to identify structure and trends. I briefly went over higher highs, marking up charts, and consolidation ranges. I'll go over that again because this lesson goes into that a little bit more. So we'll build on that foundation. We're going to learn how to read when the market is expanding, aka breaking out, and when it's contracting, ranging. This skill is really important. It really separates reactive traders from strategic ones. So these are the four main objectives for this module. We want to differentiate between trending and ranging markets. We want to confirm valid breakouts and avoid false signals. We want to understand how to identify range conditions, and we want to develop a framework for deciding when to go long, short, or stay out. It's really important to recognize your market context. Before entering a trade, you always want to define the environment you're in. So you want to ask yourself, is the market making higher highs and higher lows, aka uptrend, or highs and lows staying in the same range or the same area? So traders often lose money because they use trending strategies in sideways markets or range strategies during strong trends. So your first step is always context. You want to zoom out, ideally the 4-hour or daily time frames, and you want to look for structure and identify whether price is moving directionally or sideways. So a good tip is using the EMA indicator or the moving average. Is it flat, and is volume low, and is the market in a range? So for this section, so for breakouts happen when price moves beyond a key level of resistance or support with strong momentum. A breakout isn't confirmed by a single wick or spike. You want to look for a candle close beyond a level, increased volume, a retest that holds the breakout zone as new support or resistance. Without these confirmations, you're often chasing fake outs. And when you're taking profit or deciding how much risk to undertake, 2 to 1 risk to reward is really good. So for 2 to 1 risk to reward, you wanna, let's say you place $1,000 trade and your profit target is 20% above where you place your entry. So a 20% move would be $200, and a 10% loss would be minus $100. So you could take 2 losing trades in a row, and if you win on your third trade, you'll be break even. You can target different risk to rewards as you get more experience in the market. You could do it 3 to 1, but 2 to 1 would be a good beginning starting point. So before I get to this slide, I'm gonna bring up some examples of what I was talking about. So I was talking about ranging and breakouts. So I'm gonna show you an example of Ethereum right here. So this is the 4-hour chart of Ethereum, and a very easy example of consolidation or range is right in front of you. I'm gonna give you like 5 seconds to try to figure out what I would probably be marking out. There's a couple, but there's one really obvious one right in the middle. So I'm gonna show you an example. Let's see. Okay, I want to. This right here is a pretty prime example of consolidation. So the market consolidation consolidated from May 8th all the way to June 20th. Oh, yeah, June 20th, right? And you see that this was a support area, this was a support area. There's a lot of resistance at these areas. There's a little fake breakout here, and there's another breakout here slightly above this level. But as you can see, when this consolidation range broke this low right here and this low, you would enter a short position and you could hold that position for as long as you'd like and take profit on the way down. But you can see that because it broke this consolidation range, you can obviously take a short. So you would want to confirm. You see this candle right here for the 4-hour time frame, and the next red candle breaking below here. That's when you'd ideally want to take your short position. Another indicator I spoke about was the exponential moving average. Another one I really like is stochastic RSI. So this can really help show you whether or not an asset is overbought or oversold. So if it's above this range, it means the asset is overbought. And usually when something is overbought, that's when I like to start clipping and taking profits. And when something is oversold in the time frame, that's when I really like to enter a position if I'm longing the market. And it's going to be vice versa if you're going to be shorting the market. So right here, if it's overbought, ideally you'd want to short. And if you shorted, you would have made a good amount of money. And right here, if you short when it's overbought, so really utilize this stochastic RSI to help you enter positions. I mean, there's a lot of ways to enter positions, but that's how I like to do it personally. So, all right, I spoke a little bit about shorting positions with that Ethereum example, and I spoke about recognizing range conditions. So I'll go back to the Ethereum chart. You'll see that the chart really like to fluctuate in between this range. Like price love to bounce in between 2,700, 2,300, 2,700, 2,400, and then 2,700, 2,400 or 500, back to 400, almost had a breakout, and then it broke this support at 2,400, nuked all the way down to 2,100. So when you see multiple fake outs like I just showed you, you want to stay patient, and then the best thing is to really wait for a breakout. So you can use the stochastic RSI or the EMA. You can see if the chart is making higher highs, then you'll probably want to enter a long. If it's below the exponential moving average, you want to or making lower lows, there's a short bias. And if the EMA is really flat or sideways, there's a neutral bias. And if there's no confirmation, you shouldn't take the trade. The more times the price touches a level, the more significant it becomes. The market really pays disciplined traders who wait for clear confirmations. So this is going to be something you can do. You can pull up an Ethereum chart. I used Axiom as my trading platform because you can trade with some leverage. And I want you to start marking up charts and try to figure out which charts are consolidation, which charts are making higher highs or breaking out, and try to figure out how to make those trades for yourself. So for the homework, you want to download the breakout versus range checklist PDF that I created. If you could find two breakouts, two breakdowns, aka when the market starts nuking, tanking for your particular asset, and two things that two areas where it ranges. You want to annotate your chart, highlight confirmation signals, write what confirmed or invalidated your setups, and share charts with the community. So I hope that really helped. In this module, you learned that not all movements means opportunities. Sometimes the best trade is no trade. Identifying whether the market is ranging or trending and waiting for confirmation, you'll stop over trading and start catching cleaner, higher probability setups.